Hello there. So in this video, we're going to do some practice involving the current account and the financial account. Bleh. And then we're going to do a little bit of graphing and some thinking about tariffs. So this first part is all from the U.S. perspective, right? Notice that I bolded it and underlined it and all that stuff, because students sometimes get really confused with this. If we don't know like which one's the perspective of it, then you wouldn't know the inflow or the outflow. So we're going to determine, is it flowing money into the United States, flowing money out of the United States? And then is it counted on the current account, financial account, or neither? If it's neither, then that means that it's not an inflow or an outflow either. So first one says an American student studies and pays tuition at a university in Australia. So hopefully you can figure out from that one that that's an outflow. And we're just going to go through this column first and then see what the current account, financial. Actually, we'll just do it. We'll go straight across. Forget it. I'm making it up as I go along. So thinking about what's this person paying for, right? It's a good or a service. Tuition at a university is a service. And so one of the ways to think about the current account and the financial account is that this account, the financial account, is assets, and the current account is other stuff, right? So it's stuff and income, right? It's income and stuff. Net exports is stuff. And this is assets like stocks, bonds, right? Real estate. And so that'll kind of help us as we think about these. Is it an asset? If it is, then it's the financial account. If it's not, then it's going to be the current account. And so this is the current account. Right? This is a service. German telecom company buys microprocessors from an American company. So that's a inflow. This money is flowing into the United States, and it's stuff, so it's current account. American bank buys Japanese stocks on the Tokyo stock market. So this is American money flowing out, and it's a stock, so it's an asset, so it's on the financial account. An American doctor sends money to her family in Ghana every month. So this would be like income or kind of other forms of income. So we call those transfers, is another way to think about it. So it's an outflow on the current account. The American company Walmart earns profit from its stores in Europe. And so profit is a form of income. And so this is an inflow, right? Because it's money flowing into the United States on the current account. The US exports and sells cars to Canada. So we're inflowing money on the current account. Again, the trickiest part is remembering, even if the stuff is leaving, it's the money that we care about for inflow, outflow. Brazilian company buys an apartment building in Boston. So this is money flowing into the United States, and it's an asset, it's real estate, so it's the financial account. Central Bank of China buys a US Treasury bond. So this is money flowing into the United States because they're buying our bond. That means they're taking our bond, but they're giving us money, and that's the financial account because it's an asset. The US imports oil from Venezuela. That's stuff, so we know it's the current account, and it's an outflow of money from the United States. The American company Pepsi buys land and a factory in Mexico. So this would be an outflow because the money's flowing out to Mexico. And this one, land and a factory, that's real estate. So that's the financial account. An American businessman is paid dividends from a French company. So this is money flowing into the United States. And it's income because it's dividends, it's the income. It's not the value of the stock, but it's actually the income from it. So it's the current account. And Belgian InBev purchases American company Anheuser-Busch. And so this would be an inflow because it's money flowing into the United States, and it's on the financial account because they're buying stocks, right? That's actually how you purchase a company, is you buy their stock up. So that's how that happened actually in the United States. Now let's take a look at how this would look in the flow of financial capital between two countries. And it tells us we've got France and the United States. And the real interest rate in France is 5, and the real interest rate in the United States is 2. And then it's kind of asking us a second question that we'll look at in a moment. So the first part, QLF, and we're going to do two graphs, right? We've got a graph for France and a graph for the United States. And we need I sub R for these. And we're going to go ahead and make sure we label them so that the grader knows this is the France one, that's the United States one. And it tells us right off the bat that the France rate is 5 and the US one is 2. So the trick to doing these is you put the demand curve just down the middle like that. And then you go, okay, the one in France is 5. The one in the United States is 2. So that means like the initial supply curve has to be like that and like that. And then it says that there's going to be a flow of financial capital between the two countries, meaning that like the Americans are going to flow their money over to France, and any people who are French who had had money in the United States are going to pull it out and bring it back to France. And so this supply curve, the American supply curve, is going to decrease, while the French supply curve is going to increase. And if I did this correctly, they should equilibrate in the middle. Now, they might equilibrate at 3, they could equilibrate at 4.5 or 4 or something like that. It has to be somewhere in between the two, but it doesn't actually have to be the midpoint between the two. Now, if we notice what happens with the quantity of loanable funds here, right, and thinking about that, the quantity of loanable funds and the interest rate go up. In the United States, the interest rate goes up and the quantity goes down. And that's going to reduce the availability of money for American companies to do investing in physical capital. But in France, the interest rate fell and it created more opportunities in France for borrowing, right? There's more borrowing going on and lower interest rates. And so after the flow, the country that will have a higher rate of investment in physical capital would be France. And that's because, again, their interest rate is lower, and so it's cheaper for companies there now to borrow. Okay, now let's take a look at this last question. This one kind of is a thought question. There's no graphs with it. And by the way, both of these are from an AP test. So these are both AP questions. Suppose Mexico lowers its tariffs on imported automobiles. So that's like lower tariff, right, is really important here. How would that decrease affect each of the following? Mexican consumers. So think back, what do tariffs do? Well, they're a tax on imports. And it makes imported stuff more expensive. And it means that the prices of those things would be more expensive. So is the decision to lower the taxes good or bad for the Mexican consumers? Well, it's good for them, right? They're going to be helped by that. But what about Mexican automobile manufacturers? Now they're not going to be able to compete as much because these imported automobiles are going to come in and they're going to be cheap. So it's going to hurt the Mexican manufacturers. Now, this is the really tough part, financial account balance. So think with me for a second. If now, right, there's a lower tariff on imported automobiles, so we would expect there now to be more imports, right? More imports of cars, which is what this is talking about. And so therefore, what happens to the current account? Current account moves towards deficit, the Mexican current account, because now we're importing more, and that means that basically there's more money flowing out from Mexico. So the current account is moving toward deficit. And this is asking about the financial account. And we know that the financial account and the current account always move opposite of each other. They balance each other. So therefore, the financial account has got to be moving toward surplus. So that one's pretty tough. And it says, given the change in Mexico's current account, what will happen to aggregate demand in Mexico? Well, current account is moving towards deficit, and where they're importing more cars because it's cheaper to do that now. And so the aggregate demand we would expect to decrease because net exports are going to decrease. And remember, net exports is exports minus imports. And so if we're importing more, that's going to cause aggregate demand to fall. Now it says, assume instead of the change in tariffs, so this is just a totally separate ball game, that there is an increase in real income in Mexico. How would this affect the Mexican current account balance? So basically this is saying that the ordinary Mexican person is going to be better off, right? They're doing better. And so they're going to buy more of everything. They're going to buy more of Mexican stuff, and this ordinary Mexican household is going to buy more other things from other countries. And so this will increase imports, and therefore the current account moves toward deficit, right? And so that one's kind of tricky, but it's basically the same outcome as what we described earlier. The current account's moved into deficit, the financial account would move to surplus, and it's again kind of asking about that equilibration. All right, hopefully this helped you. I'll see you next time.